Welcome back to the Deep Dive, where we decode macro, liquidity, and global incentives.
Glad to be here for this one.
Yeah, so today, most traders look at the biggest currency pair in the world, right? The US dollar versus the Japanese yen, and they think, oh, it's just this simple math equation about interest rates.
Right, like a basic subtraction problem.
Exactly. But they are completely missing the bigger picture here. I mean, we are stepping completely away from all that daily noise today. No retail spreadsheets.
Yeah, you have to. Measuring retail day trading in this pair is, it's like measuring ripples in a pool, right? While institutional macro is tracking the actual tectonic plates shifting beneath it.
Totally.
If you only track the screen ticking red and green based on, overnight rate expectations, you are just entirely blind to the actual capital flows, the flows that dictate the medium-term trends. You really have to understand the underlying liquidity plumbing.
Let's zoom out for a second. Think of the global financial system as this highly leveraged, incredibly interconnected ecosystem. And in this architecture, Japan functions as the world's discount funding mechanism.
Basically a massive zero-cost ATM for the entire global financial sector.
Exactly, a giant APM.
Yeah.
And the US dollar, conversely, is the ultimate safe deposit box, right? It's the high beta asset haven. It's the currency required to actually clear business through the global plumbing.
The Eurodollar system, yeah.
Right, specifically the Eurodollar system. So the real terror for financial markets happens when a sudden global shock hits, right? The system seizes up and every single leveraged player tries to return all that borrowed yen at the exact same time.
And they're all trying to squeeze through a very, very narrow exit door.
Which is terrifying.
The tension you are describing there is the absolute core of the global liquidity framework. But, to really grasp the mechanics of that tension, we have to just discard the illusion of the yield spread. The conventional narrative that gets broadcasted across all the financial media, it's just painfully linear.
It's always like, U.S. rates go up, so the dollar goes up.
Exactly. U.S. interest rates rise above Japanese interest rates, so capital naturally flows out of Japan seeking higher yield in U.S. dollars, and the USD JPY pair goes up. They frame it as a pure, frictionless carry trade.
Which sounds great on paper.
Right, it sounds logical. The problem is when you actually examine the multi-year, utterly relentless trends in this currency pair, that simple interest rate math fails completely. It just cannot explain the sheer velocity and scale of these structural movements.
Because the interest rate differential is undeniably a factor, sure. But treating it as the sole driver is basically mistaking the symptom for the disease.
Yeah, that's a good way to put it.
The carry trade is a mechanical process.
Yeah.
But the fuel for that process comes from two structural anchors that uphold the entire fiat system. The first pillar being Japan's role as that ultimate global funding hub we mentioned.
And we are talking about decades here. Decades of near zero and sometimes even negative borrowing costs.
Right.
Faced with prolonged deflationary pressures and, really stagnant demographic growth. The Bank of Japan just anchored their monetary policy to the floor.
Just pinned it down.
Pinned it. And the participants taking advantage of that zero-cost capital, they are not domestic retail consumers taking out mortgages in Tokyo.
Right, it's not regular people.
No, the primary actors are massive institutional participants. You've got macro hedge funds, sovereign wealth managers, global asset managers. They secure funding in Japanese yen specifically because the cost of capital is virtually non-existent.
And they execute this through, what, prime brokerage accounts?
Prime brokerage accounts and FX swap lines. And then they immediately convert that borrowed yen into higher yielding assets across the globe. We're talking everything from U.S. tech equities to emerging market sovereign debt.
So they are explicitly funding global risk-taking via Japanese monetary accommodation, which establishes Japan as the primary liquidity provider. Then you have the second pillar, which is the U.S. dollar, acting as the global liquidity anchor.
Yeah.
It is the settlement currency for global trade. It's the denomination for primary commodities and the backbone of that Eurodollar system.
Yeah.
Which, is essentially offshore dollars created by foreign banks that the Federal Reserve doesn't even directly control.
The dual nature of the dollar is really what makes this dynamic so explosive.
How so?
Well, during periods of macroeconomic expansion, global capital aggressively hunts for yield, right? So it floods into U.S. financial markets. But during periods of severe market stress or volatility, the demand for dollar liquidity doesn't contract. It actually intensifies.
Oh, because everyone needs dollars to settle.
Exactly. The dollar becomes the ultimate refuge. It serves as both the destination for speculative greed when things are good and the fortified bunker for institutional fear when things go bad.
Okay, so putting those two pillars together reveals why USD JPY is just far more than a foreign exchange rate. It is the definitive barometer for global financial tension.
Without a doubt.
It maps that precise tug of war between aggressive risk expansion, when the global system is leveraging up on cheap yen, and sudden, violent risk aversion.
What's fascinating here is the assumption that this dynamic is driven purely by discretionary financial engineering. Like, the spreadsheet models dictate that in a risk-on environment, participants borrow yen, sell it to buy global assets, weakening the yen and strengthening the dollar.
Right. And the robots and algorithmic trading models execute this flow perfectly based on yield curves.
That's the theory, yeah.
But wait, I have to push back on that mechanistic view for a second. If the Bank of Japan starts actively signaling to the market that they might eventually abandon their zero-rate policy, and actually raise rates, wouldn't that forward guidance front-run any other macro event?
You'd think so, right?
Yeah, wouldn't institutional funds read the tea leaves, abandon the carry trade early, and neutralize the trend before it even peaks?
Well, in a purely academic vacuum, yes. Forward guidance would dictate positioning. But you are ignoring the physical reality of Japan's economy, which routinely blows up those neat little spreadsheet models.
Ah, all right.
Japan operates with a massive hidden vulnerability that overrides any central bank signaling. They have virtually zero domestic energy resources.
Wow, zero.
Virtually none. They are entirely reliant on imported liquefied natural gas, coal, and oil just to maintain baseline economic function.
Which introduces geopolitics and the energy shock accelerator.
Yeah.
Because following the Fukushima disaster and the subsequent shutdown of their nuclear reactor fleet, Japan's reliance on imported fossil fuels became this existential structural weakness.
And that physical requirement dictates capital flows in a way that hedge funds just cannot front-run. I mean, when a global energy shock occurs, Japan's trade balance implodes instantly.
It just falls off a cliff.
Exactly. If the spot price of LNG spikes to, say, $70 per MMBtu, the cost of keeping the power grid online skyrockets, and the energy producers in the Middle East or the U.S. Gulf Coast, they do not settle those contracts in Japanese yen.
No, they demand U.S. dollars.
They absolutely do.
So mechanically, the Japanese Ministry of Finance and massive domestic energy importers are just forced into the open market to aggressively sell yen and buy dollars, simply to clear their energy invoices.
It creates a relentless structural selling pressure on the yen, and that operates completely independent of the Fed funds rate or whatever the BOJ's overnight target is.
It's physical flow.
It is a physical flow of capital mandated by national survival. This is why geopolitical conflicts that disrupt global energy supply chains exert massive indirect pressure on the USD-JPY exchange rate. It forces sovereign-level capital flight.
Which brings us to the most visceral case study of our era, really, the 2022 to 2023 campaign.
Oh, yeah. The perfect storm.
Yeah, this wasn't just a standard macro cycle. It was a perfect storm where three massive structural forces aligned simultaneously to just crush the Japanese currency. First, you had the U.S. Federal Reserve initiating one of the most aggressive quantitative tightening and rate hiking cycles in modern history to combat escaping inflation.
Right. And while the Federal Reserve was destroying demand to cool the U.S. economy, the Bank of Japan was trapped in the exact opposite mandate.
Yield curve control.
Exactly. They were executing yield curve control, actively stepping into the Japanese government bond market with unlimited fixed-rate purchase operations. They had to defend a 0.25% cap on their 10-year yield.
So every time the global bond market tried to push Japanese yields higher, the BOJ basically just printed unlimited yen to buy the bonds and defend the peg.
They were flooding their domestic system with fresh liquidity at the exact moment the U.S. was aggressively draining it.
That policy divergence alone would have caused a massive currency revaluation. But the real story is the third force, the European land war and the resulting global energy shock.
Yeah, the disruption to global crude and natural gas supplies created an immediate crisis for Tokyo. Japan was suddenly hemorrhaging cash to import hyperinflated energy.
So you have the Federal Reserve making the dollar the highest yielding safe haven in the developed world, and the BOJ artificially guaranteeing that the yen remained the absolute cheapest currency on earth to borrow.
Plus the energy drain. It was a masterclass in structural currency devaluation. The widening yield differential drew in all the speculative capital, while the rising cost of LNG destroyed Japan's current account surplus.
Forcing all that massive corporate selling we just outlined.
Exactly. And, the retail market looked at that massive move and assumed it was an organic daily reaction to news headlines.
Right, they see it on CNBC and think that's why it moved.
Yeah, but institutional players, The macro funds managing tens of billions of dollars, they do not trade the news. They construct massive structural campaigns well in advance of the headlines.
Okay, let's unpack this, because the execution of a $5 billion macro position is incredibly complex. I mean, a fund of that size cannot simply execute a market order,
No, they would instantly alert the high-frequency trading algorithms.
right? They'd spike the spot price and ruin their own entry point. They have to mask their footprint.
And the execution of these campaigns happens in distinct, highly managed phases. The first phase is accumulation.
So how does that work?
Well, the large macro funds identify the structural forces aligning, like the policy divergence and the energy vulnerability, months before the divergence actually becomes acute. They build their long dollar, short yen exposure through absolute stealth.
So they utilize things like time-weighted average price algorithms, dark pools, and OTC derivatives like swaptions, just building exposure without tipping their hand.
Exactly. They step in as buyers during brief, temporary intraday dips, essentially absorbing the selling pressure from impatient retail traders.
So to the untrained eye, the market looks like it's just chopping sideways in a tight consolidation range.
Right. The lack of immediate price expansion is by design. They don't want it to move yet. But once the smart money has built their core position, the campaign transitions into the second phase, which is narrative formation.
Oh, this is when the sell-side research desks at major investment banks suddenly start publishing extensive notes on the Bank of Japan's trapped policy.
Yep, and then the financial media echo chamber latches onto the thesis.
So the narrative provides the intellectual justification for the trend. Commentators begin obsessing over the interest rate spreads. Analysts start pointing to the exact macro variables the smart money identified months prior.
Because the narrative doesn't actually create the trend, it serves as the marketing mechanism. It draws broader market liquidity into the trade.
And that consensus acts as the catalyst for the third phase, right? Momentum expansion and public participation.
That's the one. The trend breaks out of its consolidation range and becomes highly visible on daily charts. Commodity trading advisors, the trend-following CTA funds, they detect the moving average crossovers and algorithmically pile into the momentum.
And following the algorithms, the retail trading public floods the market. Capital flows overwhelmingly in one direction. And this creates a fascinating and honestly highly dangerous market dynamic.
It really is.
Because as the crowding into the short yen trade intensifies, realized volatility in the currency pair actually compresses.
Which creates a massive psychological trap. Falling volatility reduces the value at risk metrics for institutional risk managers.
So when the models show lower historical volatility, risk departments actually allow portfolio managers to apply even higher degrees of leverage to the trade.
Exactly. The illusion of safety actually breeds maximum systemic fragility. The leverage becomes totally self-reinforcing. Funds borrow more yen to buy more dollar assets because the trade hasn't experienced a meaningful drawdown in months.
But this lack of friction signals the beginning of phase 4, distribution.
Right. The structural support is quietly being removed. The macro funds who built their positions back in the accumulation phase, they begin unwinding.
They sell their dollar exposure and buy back yen. And they're executing their exits into the massive wall of inbound retail and CTA liquidity.
They are literally transferring the risk to late-arriving participants. And during this distribution phase, you begin to see subtle intraday shifts. Volatility starts to marginally expand.
The price movements become erratic, right? Characterized by sharp, unexplained intraday drops that are quickly bought back up by retail traders who are just conditioned to buy the dip.
If we connect this to the bigger picture, this entire cycle, from accumulation via stealth execution to distribution into retail liquidity, it proves that tracking institutional capital flows through cross-currency basis swaps and prime broker positioning is infinitely more predictive than reacting to a central bank press conference.
Yeah, the narrative is always a lagging indicator. The capital flow is the leading indicator.
Always. And a prime example of that lag is the market's misunderstanding of how this massive, highly leveraged structure eventually resolves itself. We are talking about trillions of dollars of borrowed yen deeply embedded in global risk assets.
Right. Which brings us to the risk scenarios and the ultimate market reaction. We have to address the safe haven paradox here.
Oh, this is crucial.
Because on a fundamental basis, it seems completely illogical. If Japan's economy has been historically stagnant, if their monetary policy yields absolutely nothing, and if they're completely dependent on imported energy, Why does the Japanese yen violently appreciate in value the exact second a severe global financial crisis or geopolitical war breaks out?
Right. It doesn't make sense if you're just looking at fundamentals. The appreciation has absolutely nothing to do with the fundamental attractiveness of the Japanese economy. It is a purely mechanical reaction driven by the structure of the global balance sheet. It is the unwind mechanic.
We saw this vividly during the 1998 collapse of long-term capital management and again during the 2008 Lehman Brothers crisis.
Yeah.
The yen didn't rally because investors suddenly believed in Japanese corporate earnings.
No, it rallied because of a forced buying panic. When global markets suffer a systemic shock, liquidity evaporates instantaneously. The hedge funds and asset managers holding highly leveraged global assets, they prioritize capital preservation above all else.
So they immediately liquidate their emerging market debt, their U.S. equities, their high-yield credit.
Liquidating the asset only solves half the equation. If a fund sells a U.S. tech stock, they receive U.S. dollars. But the liability sitting on their prime brokerage balance sheet is denominated in Japanese yen.
Ah, so they still owe the funding currency.
Exactly. To extinguish that liability, the fund must take those dollars, enter the foreign exchange market, and aggressively buy yen.
And when every major leveraged participant in the global system hits the panic button simultaneously, you have a massive, coordinated short squeeze on the Japanese currency.
It's violent.
It's like a crowded theater where the entire audience purchased their tickets using borrowed money from the box office. When the fire alarm triggers, everyone rushes the exit doors. But the exit doors are locked until you pay back the box office, and the only currency the box office accepts is the one nobody brought with them.
That's a great analogy.
The resulting scramble just forces the value of that currency aggressively higher. The participants are legally obligated to buy yen to avoid defaulting on their prime broker margin calls.
And the mechanics of a margin call do not care about fundamental valuations. It is a liquidity vortex. As the yen strengthens, it triggers stop-loss orders on other carry trades, which forces more yen buying.
Creating an aggressive feedback loop.
Exactly. But the short squeeze from speculative funds is actually only the first wave.
Wait, really? There's more? Because I was looking at the tick data, the Treasury International Capital Reports, and you could see the massive footprint of Japanese institutional selling during these stress periods. It's not just speculative fast money unwinding. It's the real slow-moving domestic capital shifting the tectonic plates.
Building on that tick data, if you look at the behavior of the Seiho, the massive Japanese life insurance companies, and the government pension investment fund, the GPIF, you see the secondary tidal wave.
Oh, wow.
These institutions manage trillions of dollars in assets. Because domestic Japanese yields have been anchored at zero for so long, these conservative institutions were forced to buy U.S. treasuries and foreign credit just to meet their actuarial yield requirements.
So they are carrying enormous unhedged or partially hedged foreign currency exposure.
Right. And when global uncertainty spikes, their institutional mandate demands extreme risk aversion.
They liquidate their overseas portfolios to bring their capital back to the perceived safety of domestic markets.
And these repatriation flows are staggering in size. To bring that capital home, the Seiho and the pension funds must aggressively sell U.S. dollars and buy Japanese yen.
So you have the global speculative community frantically buying yen to cover their margin calls, perfectly synchronized with trillions of dollars of Japanese institutional wealth buying yen to repatriate capital.
It's a massive wall of buying.
But here's where it gets interesting. We've mapped out the entire institutional architecture. We've dissected the zero-cost funding hub, the eurodollar liquidity anchor, the physical energy vulnerability, the stealth accumulation of macro campaigns, and the violent mechanics of the safe haven unwind. The critical question is how a sophisticated market participant actually applies this framework.
Well, the fundamental strategic implication is the requirement to permanently abandon the simple rate differential mindset.
Just throw it out.
Throw it out. If your analytical framework relies solely on charting the spread between the Fed funds rate and the BOJ target rate, you are effectively reading the marketing brochure while the building's foundation is being demolished.
You have to identify the campaign bias. A forward-looking, probabilistic outlook demands tracking the actual plumbing of global liquidity.
You monitor the cross-currency basis swaps to gauge the true cost of dollar funding. You analyze the hedging ratios of the Japanese life insurers. Are they rolling their FX hedges or are they letting them expire?
Because that would signal a structural shift in their risk appetite.
Precisely. Furthermore, you must maintain a laser focus on geopolitical energy choke points. An energy supply shock will override every piece of central bank forward guidance. It forces physical capital flows that bypass interest rate logic entirely.
You also have to monitor the broader security architecture in the Pacific, right? I mean,
Yeah.
Japan is the cornerstone of U.S. strategic influence in Asia. Any escalation in territorial disputes or military posturing in the South China Sea alters the risk premium of utilizing Tokyo as a global funding hub.
Absolutely. If the institutional perception of regional stability deteriorates, risk managers will forcibly reduce their reliance on the yen carry trade. And that triggers a slow motion unwind long before any actual conflict occurs.
The market is always quietly setting up the architecture for the next major campaign phase. The accumulation of the next massive structural trend is happening right now, disguised as just random daily noise.
And your edge in macro is recognizing that structural alignment before the narrative formation phase takes over the mainstream financial press.
Because by the time the television analysts are explaining the trend, the institutional distribution phase is already securing profits.
You have to track the offshore dollar plumbing, respect the physical requirements of energy importers, and deeply understand the brutal mechanics of an institutional unwind.
So what does this all mean for you? It means true market intelligence isn't found in reacting to the data. It's found in understanding the incentives of the institutions creating the data. I want to leave you with one final provocative thought to mull over. We've just mapped out how the valuation of the global financial system is deeply intertwined with trillions of dollars in virtually free, borrowed Japanese yen.
Trillions.
That capital has relentlessly fueled the expansion of global tech equities, real estate valuations, and emerging market debt. So ask yourself this. What happens to the underlying price of your favorite high-beta stocks or the liquidity of your local real estate market if an unexpected geopolitical shock forces that massive, multi-trillion-dollar global carry trade to violently unwind over a single weekend?
The assumption of permanent, frictionless liquidity is the most dangerous assumption in finance.
Keep questioning the consensus. We'll see you next time.